How is everyone today? Keith at Crypto Bullseye. We're going to be talking about Polygon in this video, and this one's at the request from Benton within the Discord group. So it's an interesting one because I haven't actually covered Polygon since the merge from Matic. When the merge from Matic happened, Polygon went all the way up to $1, and then there was such a sell wall. It pushed price action down and pushed price action down to pretty much where it started. And it's been stagnant since and then trending in a downtrend. But there's a couple of key indications that have been brought to my attention just since I was looking at that this morning that's showing that there's more buying pressure, like there is more buying pressure than what the charts are showing us. So I'm going to go through this step by step, guys, and show you exactly what I mean. Okay, guys, so Polygon Matic, and one thing that I will say, you're either going to love me or you're going to hate me at the end of this video, because some of you might even unsubscribe, because I want to ask you a question and I want an honest answer from you. Would you rather have short form videos which spoon feed you information, spoon feed you data, spoon feed you levels, or would you rather understand how to read a price chart yourself? Because in this video, guys, I was talking about buying, I was talking about selling pressure. We're talking about levels of good support, levels of good entries, how you would prepare yourself from a risk to reward perspective, i.e. stops, targets, entries, and how would understand exactly what your maximum risk is, what your maximum reward could be, how you can identify support and resistance. I'm going to do a deep dive in this video, I promise you that, guys. So it might be a bit longer than usual. Skip to the end if you want the actual final result, guys. But if you want to know and you want to understand and you want to educate yourself and you want to self-develop yourself, watch it step by step, guys, and try and understand the data yourself. Because the more that you look at a price chart, the more that you understand key levels of support and resistance, the more that you can understand fair value. The more you understand fair value, the higher probability that you've got of success. You go to a shop, guys, and you buy two items. The two items that are on the shelf are exactly the same as each other. One's a higher price, one's a lower price, exactly the same product. You're going to buy the lower price one. You're going to identify that they're two different prices. You're going to go for the lower one, guys. It's exactly the same with markets. Make sure you know what you're getting into. Make sure you understand your risk. Make sure you're getting the best value possible. So I did digress there a little bit, but what we're going to start with is the Polygon price. It's currently trading at 24 cents. You can see here that there's more buying pressure than selling pressure. Buy opportunity as far as max data is concerned, saying 73%, 57% are buying. There's a bit of news down here. I'm not going to go into it, but the rise of ZK Sync era, second pole on the on-chain RWA market. So it's got a bit of positive news going on here that we're not going to go into in this video. Right, as far as the BSP is concerned, that's pretty central. So that's showing a level between buyers and sellers. You're not getting too much data from this at the moment. So I'm going to jump into the price chart. And you look at the price chart, and this is what I was talking about in the introduction. You can zoom into this. So at the start of the day, Polygon started at 37 cents. By the end of the day, during the period of the day, during the period of the session, it went to $1 exactly. Then by the end of the day, all the way back down here, 41 cents. So 41 cents, that was the key resistance level. That's going to be a key resistance level. And we broke it twice, three times. So we broke it for three times. Then we had a bit of an upturn, and then that was followed by a downturn when you zoom out. So we're currently, like I say, trading just under 24 cents. There's no data to go by on a raw price chart. That's why I've started it, guys, because we're going to build in the data ourselves. Now, I've said time and time again in previous videos, as far as strategy is concerned, if you're new to crypto, how can you identify what level of support and resistance is? What is a good level of resistance? What is a strong level of support? What we can do is we can go onto the top of TradingView and you can stick the line chart on there. Now, what the line chart represents, guys, is the candle close. So what does that do? It takes out the volatility of the day. It takes out the noise of the day, i.e. the wicks to the upside, i.e. the wicks to the downside, and it shuts on the candle close. So each one of these points here is a candle close. Now, what we're looking to do, guys, as far as applying support and resistance is concerned, is join the dots. It's simple as that, guys. We're going to join the dots. We did this at school. We can do it here. So what we're looking for is the most touches. Now, the most touches on a daily close is going to give you the highest support or the highest resistance, depending whether you're above or depending whether you're below. So let's do this together now. So the first thing here, you can see a build up a price action. You can see this build up a price action that goes back here, and we can count how many times it's touched. So it was support here, come back down, fell through, resistance, resistance, and then resistance. And this is going to be a key level. So that level's sitting at 37 cents. Now we're going to build in a couple of key levels. There's not much data to go by here, but there's a key level here because it's touched once, it's touched twice, and now it's getting a reaction as resistance. So that's resistance, and that's sat at 32 cents. So the next level, how many touches do we get down here? We get 1 touch, we get 2 touch, we get 3 touch, and then a rejection. So that is going to be a key resistance level. This just simplifies it, guys. How many times is it touching? The less touches, the less resistance, the less support, depending on whether the price is above or depending on where the price is below. So we're just building these, guys. Here's a few. You see, resistance, that flipped as support, held as support, flip back down. When price comes back to this level, expect that to act as resistance. It's the more touches. Psychology behind it, guys, is buy orders and sell orders. You've got bulls and you've got bears. You've got bears selling at resistance. You've got bulls buying at support. So what happens? You've got more buy orders at support when you're in a bullish trend. You've got more sell orders at resistance when you're in a bearish trend. What happens in the middle of these gaps, guys, is a limited amount of price action. If the bulls lose this key level here, the bulls have got stop losses below here. When they've got stop losses on there and the stop losses get triggered, it creates a surge in price action down to the next key level. The next key level is the next support level. And that's where the bulls have another turn. That's where the buy orders put in their buy orders. So just an example. Let's use a hypothetical example here. So you've got the bulls here. And they're shooting for this swing high here. They've got their sell order here. Sorry, their stop loss here. So what happens when they lose this key level? The bulls know once they've lost that level, they're out. Once they're out, they want to be back in at the next key level of support. So they have their stop losses. Everybody's got their stop loss here that's bullish. Once the stop losses get triggered, guess what happens? The sell orders eat away at the buy orders, and you get a surge in price action down to the next key level of support. When that comes back down, the buy orders outweigh the sell orders, and the tug of war battle happens at these resistance and support areas. So that's why it's important, guys. Can we build in a couple of more? We can add a couple of more up here. Up here, you can see that was support, resistance. So that's held a few times. Then we can also stick one up here. That's 3 touches. Remember, the less touches, the less resistance. Right, okay, so that is the simple way how you can add your support and your resistance. Remember, the line chart takes out the volatility, the noise, the spikes of the upside and the downside as far as the wicks are concerned. Now, next thing we're going to look at is the price chart. Now, because we took out the noise, look what happens. You've got wicks here, you've got wicks, you've got wicks, you've got wicks. So all of these wicks, guys, that's what the line chart takes out, the noise. And you can see how price reacted at these levels. Acted as support by the day end, but during the session, it went all the way down here. So we've taken out the noise. Next thing we're going to do is add in a trend line. We've got a diagonal here. Crypto loves a diagonal, guys. And we talk about this as well. 1, 2, 3 fake outs. You'll see this time and time again. Get yourself a simple trend line, go on a chart, put it on a trend, and then I want you to count 1, 2, 3. 1, 2, 3 fake out. Why do I identify 3 touches as a trend confirmation? It's because of the 1, 2, 3 fake out. Actual traders trade this, guys. You've got 1, 2, 3 fake out traders where they're trading the 1, 2, 3 fake out, and then you've got the opposite traders, which are selling the 1, 2, 3 fake out, pushing it back in. So there's lots of different traders with lots of different strategies, and they all sometimes line up. That gives additional confluence, guys. When you've got additional confluence in a bullish trend, there's more buy orders at certain key levels when their strategies are met, which pushes price action higher. So the first thing that we're looking for ideally here, guys, without even bringing the indicators on, is a crack of trend. We want a crack of trend. What does that actually confirm? Crack of trend confirms that the bulls, for the first time, have actually got momentum to break through here. And that means, more importantly, there's a high probability that you've put in a low. So it gives you an idea of risk to reward. Now, if you're adding your risk to reward tool in here and that broke here, you know that you're wrong below the previous swing low, and you could be shooting for the previous swing high. You can look at your risk to reward and you could say 7.28 risk to reward. So what that means is if you say 8, just as an example, 8 to 1 risk to reward. What that means is if you took 8 trades like this, guys, 8 trades like this, if you won 1 out of 8 trades, that would mean that you would break even. Now, if you took this 8 times and you won 2 out of 8 trades, that would make you really profitable. That would give you a low percentage win rate, but that would make you really profitable. You don't have to have 99%, you don't have to have 98%, guys. You can have 20%, you can have 30%, you can still be profitable, but depending on what your strategy is. If you've got an 8 to 1 risk to reward and you take it 8 times, you win that twice, you do that consistently over a period of time. That's consistent profitability, guys. That's a money-making machine. It's not as easy to do as you think. And these trades don't set up like this all the time. So there's lots of different scenarios, and that's why you need a rule-based system. So while we're talking about a rule-based system, I'll ask you this question. Crypto class was unsuccessful. Not many people watch crypto class. Now, how would you feel if I created a step-by-step strategy, a rule-based strategy over 7, 8 videos, for example, which built in a rule? It told you why that rule was built in. It showed you the indicators behind it. It showed you the thesis behind the price action. It showed you the candlestick patterns. It showed you exactly what needed to happen, step by step, that you follow it. If then when the conditions are met, then you can take the trade, then you can protect yourself, then you know where your targets are, you know where your stops are, you know where your entry needs to be. Would you like me to do a series of videos like that? That's the question that I'm asking you, because it'll take me some time, guys. But like I say, crypto school, nobody wanted to self-develop during crypto school. That was the least amount of videos or the least amount of views on my videos. So if you want me to create that, I will create that, but let me know in the comments. And if I get enough people asking for it, I'll be happy to do that. Take my time, guys, because at the end of the day, I don't get paid for this. It's something that I do because I want to create a community. I want to build a community of like-minded people that are all passionate about the same thing, a new monetary order, some kind of change, something that's going to give us a way out, guys. So I can't do it by myself. Community, I always say that I can learn something from everybody. Surround yourself by people that are smarter than you, and every single person that you speak to, you can learn something from. That's what I always say, guys. I'm not perfect. I'm still learning every day. I'm still self-developing every day. And I want to just teach you guys everything that I know as I'm self-developing myself. That's my goal. Right, okay. God, that was long-winded. Just want to show you another thing, actually, guys, while we were talking about the line chart. So we've got the line chart there. That takes the volatility out of the ups and the downs as far as the spikes are concerned. You've got your standard Japanese candlesticks, and you've also got this. This is something I don't show very often on my channel, but this is the Heikin Ashi. Now, Heikin Ashi is like a trend-based candlestick. So as these go up here, you can see that you've got a green trend here, you've got a pullback, and that's red, and you've got a push to the upside, that's green, you've got a pullback that's red, you've got a push to the upside that's green. So you can see all of these candles are green, and then during the downtrend, opposite, red, green, red, green. So you can use this to help identify whether you're bullish or whether you're bearish. When these candles start to turn green and you start breaking trend, showing that you're going to get a big push, or you're likely to get a big push. It's a probabilities game, guy, probabilities game. So back to the Japanese candlesticks. Next thing I want to know is, are we overbought or are we oversold? So we're going to bring up the indicator, and you can see that the stochastic is coming into oversold territory. So it's coming into oversold territory, showing that we're ready for some kind of reaction. We're ready for this crack of trend. Why is the crack of trend important, guys? Because we're in a downtrend. So there's potentially, it could go like this, it could go like this. So if you're taking a trade here, for instance, and it doesn't crack trend and it continues to the downside, it means you're missing opportunities here, but it means you're in a loss down here. So wait for momentum, wait for the crack of trend, protect yourself, understand what your risk to reward is, make sure you can live to fight another day. So there's another thing that we can see from the indicators here, and this is the positive thing that is showing me that there's definitely more buying pressure than what the charts are making out. So let me show you about divergences. How do you measure a divergence? And does this wick matter? We talked about the line chart, the candle close, taking out the volatility of the upside, the volatility of the downside. The RSI does exactly the same. So the RSI discounts this candle and it waits for the candle close. So when you're measuring divergence, you don't measure it like this. Don't measure it like this. Measure it like this. So that is showing that we're putting in a lower high, a lower low, a lower high, a lower low, and we're trading in a descending channel or a descending wedge, which is a bullish move. Now, the next thing is this, the RSI. RSI is telling us a completely different story, and this is measuring buying and selling pressure. And this is what I was talking about in the introduction, buying and selling pressure. Is there more buying pressure? Is there more selling pressure? We looked at Max Data app, and we could see it's more buying pressure, 73% buy opportunity, 57% buy-in. So you can see that you could, on the RSI that measures buying and selling pressure, we've done one thing here. We've put in a higher low, we've put in a higher low. Right. When we compare that, exactly the same place where price is, we put in a lower low, we put in a lower low. So that's signaling that we need to get a reversal. We talked about it on the Cardano chart. Let's quickly go over this divergence on the Cardano chart. We said we put in a higher low here. Expect when this comes down here that you're going to get a reaction. On the Cardano chart, we've got the reaction. The divergence played out here. Then we've got a big pump to the upside. So this is what I'm expecting on Polygon. Once we break through this wedge, we understand there's a high probability that the low's in. You've got a good risk to reward. If you're wrong, you're wrong. You live to fight another day. The levels get lower. It means you get a better entry, guys. If you lose 2-3%, so what? If you get 20% cheaper, you're laughing. That's why risk management's the key. That's the most important thing that I teach on this channel, guys. So that's what I'm saying, guys. That's how I'll be playing it. Is it a good buy now? Is it a good buy now? This, to me, is when it's a good buy, when we get a break and when we get a close above, understanding where you can protect yourself, understanding where your reward is. And guys, when you've got something like an 8-to-1 risk to reward, you've got something like an 8-to-1 risk to reward, and you get an absolute banging entry. You get here, banging entry, and you're riding it up and you're riding it up and you're riding it up and you're riding it up, and then something like this happens. All of that was for nothing. That would have been such a painful move. So what else we teach you on here is trailing stop losses. And you get trailing stop losses, guys, on exchanges. Don't use trailing stop losses on exchanges. They'll say 2%, 3%, 4%, 5%. How do you know where the swing high and the swing low is going to be? How do you know how volatile a pullback is going to be? You need to be looking at when you get a break, you've got your entry, once you've got your close. When you get your break, you understand where your entry is. If it's there, you put in a higher high, take out this previous higher high, come back down, you put in a higher low. You take out this previous high, then you protect yourself. Now, this is the clever thing with risk management. You put yourself in profit, you take away the risk, and then you can keep doing that and you can keep doing that. And all the way during the higher lows, each time that you put in a new higher high that confirms the previous higher low, you put your stop loss below the higher low. When the trend reverses, if you're wrong, you still get a big chunk of the move, guys. So you don't want to be taking a good entry, it not making your targets, then coming back all the way down and stopping you out. Something that you can use risk to reward, risk management, good risk management tools to help you along the way with that. But like I say, you're either going to love me or you're going to hate me. But that's just from a TA perspective. We haven't even actually, let's follow on from this. I'm going to add a couple of things on here, guys. Anyone that's watching now, you're the self-developers. Right. Next thing that I'm going to show you is called fixed range volume profile. So what happened here? So you've got fixed range volume profile. You take it from the swing high, and what this does is it measures the mean. It measures the area of most traded volume. What you can do when you look at this, as you can see, how this acts as support and resistance, support and resistance, support here, support, and then it turns resistance. This is going to be a key area, and that's at 40 cents. So 40 cents is nearly a 2x from where price action is now. That's going to be where price is likely to react, and it could go something like this. Up, 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 hit this point here, come back down, test this previous resistance as support, and then continue putting in higher highs and higher lows. Next thing that I want to show you guys, moving averages. Is this video too long, or do you want more videos like this? You've got the SMA on here. We've got the 50 period moving average, and you've got your 20 period moving average. Now, I want to show you how price reacts to this 20 period moving average. We keep getting rejected. keep getting rejected, rejected, rejected. We keep getting rejected and rejected. So once we break trend, guys, once we break trend, and this is flipped from resistance to support, that's showing that the trend is changing. And what's likely to happen is this 20 period moving average will start moving up. That's the faster pace moving average. The 50 period moving average will cross, and then you'll start getting bullish momentum, and they'll be holding the moving averages, the same as what they're resisting the moving averages down here. Okay, so if you want more videos on Polygon, if you want more videos with technical analysis tutorials, if you want me to do that strategy, guys, let me know in the comments. I'll see you in the next one.